So today we are going to be looking at an easy way to frame buyers on all time frames. So what I mean by framing a bias is your ability to know where price is going to move to next, spotting the next point of liquidity. Hello guys, my name is Hyper and I'm here to show you an easy way for you to know exactly where price is going for any trading day. What I'm going to show you happens on every time frame, so it doesn't matter whether you are looking at the chart from the 1 minute time frame or the 1 week time frame. Remember that price is fractal, and the fractality of price tells you that whatever happens on the lower time frame happens on the higher time frame. So what matters here is your ability to see it in real time, and if you are able to see it in real time, you are going to improve your ability to be precise with knowing where price is going next. So without further ado, let us jump into it. Relative equal highs and lows. Relative equal highs and lows. Before I start and get into it, I don't want you to see a relative equal high and lows as highs and lows that are equal. Okay, forget about the name. The name sounds like the high and lows that we are talking about are supposed to be equal like this, and the lows are supposed to be equal like this. Okay, that is not what I mean. Remember that this relative equal highs and lows doesn't mean that the highs and lows are exactly equal like this. Okay, it is some kind of a conflicting term. I am not the one that coined this term. It was coined by ICT himself. So even though the name of this concept may sound contradicting, but I don't have a perfect English for it. My point exactly is that it doesn't necessarily mean that the highs are equal and the lows are equal when you measure them. Okay, so let me quickly take your attention to the bullish scenario of equal highs and lows. So I will delete this one. I hope I made myself clear with what I illustrated here. Okay, so a relative equal high to the left, and we have a relative equal low to the right. So let us take a look at a relative equal. Okay, first of all, let us read out what I have on the screen. So we say that relative equal highs and lows, they signify an undisturbed high and low. If you are familiar with the concept of turtle soup or break of structure, you will notice that what I mean here is that a relative equal high is a high that has not been disturbed or engaged by price action. So let us take a look at this range, this high and this low. You can see that this low here has been engaged. The liquidity that lies below this low has been engaged with this leg in price action. So it means that this money right here signifies that liquidity has been taken here. Okay, so now look up here. You will see that this high, we can call it an open high because it has not yet been engaged by price, and this high is lower than this high, and this high is lower than this high. I want to give you a perfect illustration. Let me just quickly take this high like this. Now I have made this high higher than this, but this high is lower than this high. So let me ask you, is this still a relative equal high? Yes, this is still a relative equal high. Why? The reason is because even though that this high is higher than this one, this high is still lower than this high that formed this range. So relative to this high, relative to this particular high that you see here, this high is still relative equal. This high is still relative equal to this one. So it doesn't matter whether it has taken out a minor liquidity here. If you look at the wider range, you will see that it is still sitting on the within the range that made this high. So it is still a relative equal high. I'll bring this down. I'll show you now a perfect example of this in live market. Okay, so I will take your attention to the right now. So we are now looking at this range, this high and this low. So looking at this range in price, which one do you think is the open high or the relative equal high? Okay, not a relative equal high, sorry, a relative equal low. Okay, so considering that price has already engaged this liquidity that sits here, price has already engaged it with this swing price, you can see that this low is higher than this low and this low is higher than this low. So this makes here open because price is yet to engage it. So let us engage this price right here. So let us assume that price came down like this. So I'm going to quickly use this tool to indicate this price, this break of structure. So what do we have here? Now, even though that price has already swept this low here, price has swept this low here, okay, relative to this low is still a relative equal low. I don't know if you are getting me right, but you need to make yourself available to be able to sense this in price. It is really easy to see this. Okay, what I'm telling you is that once you are able to see this, you can easily come to the chart every day and point to a particular point in price and be confident that price is going to reach for that point in price. Okay, so even though that this low has taken out this low, relative to this low is still a relative equal low. So once price has engaged this high, I expect price to take out this low because there is no particular low or there is no low that has engaged it. So it is more like hanging out there and begging to be taken out. So these relative equal lows, they are retail stop loss, or you can call them buy side liquidity or sell side liquidity. So I'll just put my sell side liquidity, sell side liquidity. Okay, so I'm going to quickly go to the chart to show you an example of what I'm talking about. I'm going to take this one back. Okay, so let me just show you a perfect illustration of what I mean in price. So this is a price action that happened on the 10th of October 2024. Okay, and the particular session that I trade is the morning session of New York. So I am expecting this setup to form in the New York session. All right, so looking at this range, we can see that there is a high here and there was a low here. I'm quickly going to mark this one out. Let me use 2px for this, and also use 2px for this so that it can be clear to you. I could have paid a fortune for someone who will be able to tell me where price is going to go next. In my early stage of development as a trader, I couldn't confidently look at the chart and pinpoint where price is going to go next. Okay, but when I got to learn about relative equal highs and lows, I had already done like 50% of the job. Okay, so what I'm teaching you here is how to do 50% of the job any day that you come to the chart. And what is that? Knowing exactly where price is going by framing a bias. You literally don't need a daily bias to be able to know where price is going. You just need to look for your highs and your lows and know which one has been engaged. Once you have seen the one that has been engaged, you will look for the one that is open. Alright, so enough of that one. Let us just continue. Now, this setup that I'm showing you happened at exactly 9:50 a.m. 9:50 a.m. New York time. Okay, so literally every day I'm coming to my chart by 9:30. Once I come to my chart by 9:30, I want to see all the swing lows that has been formed from 7 o'clock to 8:30. Like this swing point was formed by 8:30, and this low was formed by 8:42, and this last low was formed by 9:50 a.m. So guys, you have to set your time, you have to set your trading view time to New York time. Okay, and the way to do that is to come to the lower right bottom of your trading view and click on time zone. Once you click on time zone, you are going to select New York time UTC -5. That is the time you engage with the market. That is the time you want your trading view time to be at, because the algorithm that delivers price runs on the New York time. So if you want to align yourself with New York, which is the capital city of trading, if I should say that one, you want to align and set your trading view time to UTC -5. Okay, I hope that was clear. All right, so let us dive back into what we are saying. Once price engaged with this low, what will even make price to engage with this low to start with? Now, if you are someone that is familiar with time and news, you will notice that New York time, there is always news by 8:30. Sometimes unemployment claims news, FOMC, CPI. There are just any economic news of high impact. Like for example, this big candle here was formed by 8:30. Okay, and if you go to August, sorry, not August, if you go to October 10, 2024 on Forex Factory, the website to see your news day is Forex Factory. Okay, so if you go to October 10 by 8:30, you will see that it's not 8:30, sorry. If you go to October 10 by 8:30, oh okay, I was right. So let us check the news that happened on October 10 by 8:30. Okay, look at the time here, October 10 by 8:30. All these red folder news, they are high impact news. So you can see the reason why this strong price action happened here on Thursday, because there was high impact news that very day. So as a new trader, I am trying to communicate with you to familiarize yourself with using time to frame the market, so you don't trade until after this news release. Okay, I basically start looking for price or looking at price from 9:30 a.m. New York time. All right, so without diverting much, let me come back to what we are doing. So price has taken out this low here and engaged it like this. So we are expecting price to target this high. Why? Because this high is still open and it is yet to be engaged. So this is a fair value gap that was formed when price took out this low. And if you are familiar with inversion fair value gaps, you will know that during this point in time, once price takes out a low and forms an inversion fair value gap, you mark out your inversion fair value gap and wait for price to close above this inversion fair value gap. Remember that a fair value gap is meant to send price down, like a sell side imbalance, buy side inefficiency. That is the difference. Let me show you what I mean by a fair value gap. If you take a look at this low, the low of this candle and the high of this candle, they are not touching each other. Okay, so the difference between this low and this high is what is a fair value gap. So there was no buy side movement inside this place. That means there was only sell side delivery. Okay, so this sell side delivery was supposed to hold price back after there is a buy side delivery. It is supposed to continue to send price down, but you can see what happened here. Instead of sending price down, price closed above an inversion. Price closes above this fair value gap, and the moment price closes above this fair value gap, it has turned to an inversion fair value gap. So you mark out your inversion fair value gap, and once price returns to the high of this fair value gap, sometimes it can retrace into the consequent encroachment, that is like the 50% mark of the fair value gap. You can take a buy entry and start to take profits Okay, so where else do we have a relative equal high? We have a relative equal high here. Why? Because this high is lower than this high, so we can call it a relative equal high. We also have a relative equal high here, right? Because this high is still high relative to this one. So you can see, I hope my mic is not disturbing me. So you can see that we have relative equal highs hanging here, and once this high and this high and this high, you have seen them, you will be able to use them as take profit points. So okay, now price has engaged this high right here, and you can see before it went to engage this price, it came back to tell you that this inversion of fair value gap has been confirmed when price came down here. So once price has engaged with that high, what remains for price to do is to seek the liquidity that rests on the opposite side of the market. All right, so let me quickly play this one to see how price engages with it. Now price has engaged with this one. I'm still going to show you a bearish scenario of what a perfect relative equal low is. Okay, so price has started to take out these highs and these lows like this one. All the retail traders that put their stop loss here, those that has been short, we have their stop loss taken when price comes to this level in chart, which brings us to the second way of describing a relative equal high and a relative equal low. You can say that they are called retail stop loss, or buy side liquidity, or sell side liquidity. Okay, so you can see that this relative equal high here is a perfect illustration of what I just showed you in price. Why? Because this low here, you can see it as that 8:30 time, and once it was 9:50, I live near the road. Once it was 9:50, price took out this low and started to build up liquidity to take out this open high. Should I call it an open high? If it sounds better to you, you can call it an open high. Okay, so that is it for the bullish aspect, or bullish price movement to engage with open relative equal highs. Guys, I hope this is clear up to this moment, but if it is not clear, I'm still going to show you an illustration of this price action in a bearish scenario, so that you can be able to engage with the market properly and know where the market is going. All right, Now this is a bearish example of how to frame a bias and know where price is going next. So the time here is 10:25, 10:30 New York time. This high right here was formed by 10:30 New York time. Okay, so you need to know the time that you trade. Okay, it is very important because time will increase the precision with which it works. Now, remember that in our bearish scenario, we are looking at a low, a high and a low, with this low having consecutive higher lows that sits within it. Okay, I just wanted to draw that one out again so that it makes even more sense. You are seeing it side by side with this price action here, you will understand what I mean. So this high right here is this high, and this high right here is this high that took out this high. Okay, so now let me take your attention down to this low and this low, even this low here, but this one is much more prominent. Okay, now what you get to notice is that relative to this low is high, and there has not been any low that engaged this one, just like this high was engaged here. So this low right here is hanging. Okay, so this low here is this low, and there has not been any low that disturbed it. So given that it is still an undisturbed low, it is a relative equal low. So I'm going to mark out this one and call it a relative equal low. And I wonder why this one is not even typing. Okay, it is a relative equal low. So we are expecting price to take out this low because it is weak, and without coverage it is inviting price to take it out. So once price takes out this high, you will look for a kind of an inversion fair value gap. Okay, you will look for a kind of an inversion fair value gap that is within this leg that took this high. Alright, I have not seen any prominent fair value gap here because this high is almost touching this high, even though it is not perfect, but that is where you expect your setup to form. Okay, some days price is going to make it easy for you to spot an inversion fair value gap and give you a very perfect trading day. Okay, there are trading days that are perfect, and once you see that price is not presenting to you that perfect trading day, you will know. Okay, now price has given us an inversion fair value gap right here. Please permit me to let me just take this one. Come on. Okay, I'll just delete this one and delete this one too, and delete this one too. So we have our inversion fair value gap. It was not easy for price to give us this one. So why is it an inversion fair value gap? The reason it is an inversion fair value gap, is because given that the low of this white candle, sorry, the high of this white candle and the low of this third white candle did not touch, which means there was only buy side delivery right here. So immediately there is a sell candle that balances price here. We expect price to continue to go higher, and any close that is below this inversion, this fair value gap, invalidates the fair value gap and gives us what we call an inversion fair value gap. So let us just watch to see when price closes below it, so that we can take an entry from the low of this fair value gap to target this low and this low eventually. Okay, so a candle has closed right here. So now we are going to be framing our bearish position from the low. If you are an aggressive trader, you want to frame it from the low of this inversion fair value gap. If you are a consecutive trader, you can take the consequent encroachment of this inversion fair value gap and use any high that suits you here. You can measure it by pips. Normally I risk just 15 pips stop loss. If 15 pips is too tight for you, you can increase it depending on your risk. Okay, but just go with what works for you. Okay, sometimes I may frame my entry in the middle of this inversion fair value gap and I will not get it. Sometimes I get it. Sometimes I frame below the fair value gap and I still get my entry. So let us just use this as a trading scenario, because I didn't check to see this one. Okay, so price is actually going back to the upside and price tagged my stop loss right there. So you see that the way price moves is random, and it depends on what price is presenting to you that very day. Okay, so okay, that was quick. So on a perfectly bearish day, you can take your positions after this high has been taken. You can take your positions below an inversion fair value gap and target relative equal lows, just like this one. Okay, and as you can see, price continues to go down. So I don't know, maybe I should just give you one more example to drive my point home. So I will give you a perfect example of this scenario on a bullish day. Okay, so just wait for one more example so that I can just brush things off and call it a day. So this would be our last example, and it's going to be on identifying a relative equal high. Okay, so let us just mark this price action together so that you can get a last refresh on what I have been saying throughout this video. Okay, so first of all, we are looking for a low to be taken. Now, which low do you think is the one that has been taken out of all the lows that you are seeing here? Or which low do you think is a perfect, come on now, come on, my house. So which low do you think is the perfect one for you to call the one that has been disturbed? Remember, we are looking for a low to be disturbed and a low that is undisturbed, or a high that is undisturbed, depending on what you are looking at. Okay, so this low right here has been disturbed with this price action. So sell side liquidity has been taken. The sell side liquidity that has been lying on this low has been taken. So this time around I'll call it a sell side liquidity instead of denoting it with a dollar sign. Let me just call it a sell side liquidity. Now, being that this sell side liquidity has been taken, let us look for at the highs our would-be targets. Now look at this high relative to this high. This high is a relative equal high. Remember that it is not a high and a low that is equal. Always remember that it is simply a high that has not been disturbed, or a high that ICT traders will just call it turtle soup. A high that has not been turtle souped. Okay, a high that has not been turtle souped. So we have 3 clean highs right here. So now price has taken out this low here and giving us a fair value gap. Remember what I told you about fair value gaps. Fair value gaps are, when you are looking at a fair value gap, you are looking at basically 3 candles, and the characteristic of those 3 candles is that the low of the first one and the high of the third one, when you are looking at a sell side imbalance, okay, the 2 of them, they are not touching each other, which leaves you with a price delivery that was delivered only to the sell side. Okay, now price has even come to close this fair value gap right here, and remember, we are expecting this fair value gap to send price down. That is what a fair value gap does. When price comes back to a fair value gap, it continues to send. When price comes back to a sell side imbalance, it is expected that price continues to sell or send price down. Now, in a scenario whereby price did not send price down, but rather allowed a candle to close above this high, it is no longer a fair value gap. It is called an inversion fair value gap. So we are going to watch price close above here, and once price closes above here, we are going to take our entry from the high of this fair value gap, and bad as it is, or as it could dip or go down again, the consequent encroachment, which is the midpoint of this inversion fair value gap or fair value gap, it is not yet a fair value gap. So let me just call it a fair value gap, yet it is not yet an inversion fair value gap. So first of all, we are looking at price, and we are now anticipating a closure above this fair value gap, and we have a closure with this candle. But if you are not confident enough, you can wait for a subsequent candle to close above it, like this one. So once a subsequent candle closes above it like this one, we are going to be looking for our entry from this midpoint, or probably from this one. So but we are going to be quite conservative with this one, so I will just go with the midpoint of this fair value gap and give it some space. Okay, your stop will be below here, but you can decide to give it any kind of space that you want, and target for your first target, you are targeting this relative equal high, which is a very easy target for you, a low hanging fruit. Okay, a low hanging fruit. let me even know whether price gives us an entry. Okay, it gives us an entry right here. It gives us an entry right here. So we have we started to see a consolidation that happens within this price range. So we now expect price to continue to send price to all these open highs and open lows. Okay, this was even a quick one. So there you have it. You have your take profit one at this level at 2.38 risk reward, and your last target at 3.62 risk reward. So guys, I would have paid a fortune to learn this. I wish I saw someone that showed me where price is going to go next when I was starting out. Believe me, this is what you need to know for you to have the odds in your favor. Okay, so if there is anything confusing you about this video, you should come back to rewatch it again. You can always come back to rewatch the video, but I want you to have a skeleton of what a relative equal high or a relative equal low is. So before I call it a day, I want to quickly draw it out again for you to see what a relative equal low and a relative equal high looks like. So for a relative equal high, we are looking at a low and a high, whereby the high has not been taken but the low has been taken and disturbed right here. So being that this low has been taken, I'll give it a star, not a star, a dollar sign. You know, this high is open, is a relative equal high. So relative equal high open, and we expect price to take it out, you know, because of these highs. They are not standing in the way of price to get to this high. So this high is very much reachable with price. It is retail stop loss. So we have our inversion fair value gap forming here, and price comes back to target this high. So that is what a relative equal high looks like. And for a relative equal low, we have something like this one. So we have something like this one. This high has been taken, which leaves this low hanging and this low hanging and this low hanging. So you can see we have three relative equal lows here. So guys, that is about it for this video. If you are still confused, or there is a particular topic you want me to touch, okay, you can drop it in the comment section so that I can assist you and make a video about it. And I hope somehow I was able to explain this one in a way that is understandable. You can always practice on your charts every day. You come back every day to look for relative equal highs and relative equal lows for what they are, and know that price is definitely going to take out this buy side liquidity or sell side liquidity or retail stop loss. Okay, so I hope you found this video insightful. Please subscribe to my channel
and give me a thumbs up, which will encourage me to continue putting out quality stuff like this for you to consume. Alright, so until I talk to you next time, please stay safe and happy trading. See you guys.